Alrighty, traders, good afternoon, good morning, good evening, and welcome to the Analyst team right here that we go ahead and talk about the market. I've got my good friends Tyson and Chris with me today. We're going to go ahead and talk about the market setups. We're going to go ahead and discuss a couple of things right here. US oil, we're going to talk about that. We're going to talk about the 1st of May. Chris has gone ahead and labeled the 1st of May being pivotal point for jobs. We're going to go ahead and talk about jobs. Obviously, we're getting weak numbers coming out, a lot of unemployment claims. We're going to be talking about that as well today. We're also going to look at a couple of currency pairs. I'm going to focus in on two currency pairs, New Zealand Swiss franc, New Zealand Canadian dollar, which also have to go ahead and look at US oil. I know that Chris is going to go ahead and take a look at the euro trading against the dollar. He's crazy. But he's going to go ahead and take a look at it. Maybe there's not an opportunity right now, but he's going to definitely look at what is the opportunity on that. And I know Tyson has got his pair that he's going to look at, which is the Euro Swiss franc. So we're going to take a look at that, talk about the fundamentals, put it all together, connect the dots, and take a look at what opportunities we have heading into the following week. With that being said, let me go ahead and introduce my panel. And we do have Chris. Chris, good afternoon to you, my friend. How are you doing?
Hey, Gary. Good afternoon. Hey, everybody.
Good. And we got Tyson. Tyson, how you doing, my friend?
I'm doing good. Good to see everybody. Happy Friday.
Fantastic. Yeah, it is Happy Friday, but there hasn't been a lot of activity this week. Now, we did have, two news reports that came out that I was really paying attention to, and that was the Aussie news, which is obviously the jobs. We had and that was on Wednesday. And we also had the Canadians decide to keep the rates unchanged, which, of course, wasn't a surprise. They kept it at 0.25%. Didn't see major reaction in the market. But with the Aussies job reports, the job reports came out pretty positive. In fact, if you look at the job reports this week for the Aussies came out at positive 5.9K. That's the unemployment change. And then the unemployment rate actually, in fact, dropped to 5.2%. What do you guys got to say about that?
I say go Aussie, go.
Go Aussie, go.
I'll say that Gary and Chris were spot on last week because you remember I said, listen, I'm taking some profits, looking for a retracement, and I want to have some levels to buy back lower. Still on that theme, going to update that theme a little bit today, but great calls by you guys. I've been long the Aussie dollar, but kind of minimized my the upside on it by hedging a little bit. But yeah, kind of shocking how strong the Aussie data is holding up. I'm interested to see if that continues to hold up into next week and the weeks after.
Well, if you look at the actual chart right here, the chart's not really reflecting too much based on what happened this week. You can see right here we've had a lot of choppiness, specifically the Aussie Canadian. And you would think with the positive news coming out of the Aussies, right, with the jobs, you'd think that that this would be a rally to the upside because we did have the Canadians that kept their rates unchanged at 0.25%. So we didn't really see any sort of big reaction in the market based on this particular pair right here. And I don't know, man. Maybe it's just me, but I think maybe the technicals are ruling right now.
I think so, and I think what you're looking at is you were looking at a little bit of anticipation of potentially things being a little bit better over in the Aussie part of the world. Got beat up, obviously, just got crushed. The Aussie just got crushed, 3, 4, 5 weeks ago, and we mentioned this a lot. Went too far too fast, and so this is just kind of that snapback, getting back into alignment. Doesn't shock me that we didn't have just a huge bullish reaction because a lot of that bullishness was baked in, last week and the week before.
Right, absolutely. So let's get into the meat and potatoes of the trading opportunities that we're going to go ahead and take a look at. And I know, Chris, you're going to go ahead and look at a wild one. You've got one. Tyson's got one. I've got two pairs I'm going to look at. I'm going to jump into mine first because it is the New Zealand Canadian dollar, which I want to talk about US oil. And I know Chris has got a lot to chat about that. I know Tyson may have something to add to that as well. But let's take a look at the chart. And this is the New Zealand Canadian dollar. Now, the first thing I'm going to go to, guys, is I'm going to go ahead and pop open US oil. And if we take a look at US oil, we're still trading, well, we're just about today trading just below that 20 mark. And we're at $18.47. Your thoughts, Chris? Do you think, and Tyson, do you think the price of oil is going to stay below 20 by the close of today, which is not too far away, so that's an easy guess. But what about next week? Do you think we're going to trade back above 20?
I mean, if I'm going to have a week to decide, I mean, I think we're going to stay below 20 for right now. I think that oil typically picks up in demand mid-May, late May, going into summer. I think that, you mentioned earlier, May 1st, that's kind of one of my big my big windows right now for the U.S. getting back to, a new normal. I'm not going to say normal, a new normal. Basically, we've wiped out, almost 22 million jobs in 3 weeks as far as continued unemployment claims, 22 million in 3 weeks, 4 weeks. So to have the demand, maybe mass transportation, public transportation is not going to be what it once was. So maybe the U.S. Worker decides to be more of a commuter. Maybe they can work from home. Maybe there's transitions going on business-wise. But I think people get back to work starting in May. I think they're likely to drive versus public transportation. I think that oil demand naturally, look, there's a lot of manipulation in oil. There's a lot of jawboning in oil. There's a lot of supply and demand that just, we're running out of space to store it. There's clearly an oversupply and a lack of demand. I mean, it's as cheap as it's ever been. I think there's one time in high school, 20 plus years ago, that I can remember gas being under $1 a gallon, and here we are at like $1.70, $1.75, depending on where you are in the country. So obviously it's the cheapest it's been in a long, long time, but yet nobody's buying it. I mean, I've had the same gas, the same tank for 3 weeks in my car. I don't need to go anywhere. So it's like, I understand why it's at $20. I understand why it's dipping below. I'm not planning on the next week to have it go to 25, 30, but if I'm going to make a choice over the next 3 to 6 months, I do think that we find a way to get oil technically back to $25, $30, maybe a short squeeze back to $35 or $40. And we balance out that big gap that happened over the weekend when Russia and Saudi Arabia decided to fight against each other, as far as who's going to flinch first. And so oil is a big game of chicken. OPEC has called a massive production cut, roughly 10 plus million barrels per day. It's about a 20% up output cut. So everyone has to play ball. Everyone has to fall in line. The same type of collective effort that you've seen from central banks, you have to see that also with OPEC and oil countries or oil-dependent countries. So if I'm making a choice, I like oil to the upside. That's what I'm willing to invest in right now. But it's certainly not long-term. I know, Tyson, you're a perma bear on oil, and we could probably get to those $30 to $40 levels, and you'd like to sell it again. I think ultimately I'd like to see us, reduce the dependency on oil as well. I think this is also a big play to hurt shale and fracking in the U.S. So anyway, but look, I'm a trader, I'm an investor, and so I like the idea of buying oil, where it is and having levels to add to it, having some dry powder to add lower. So symbols I'm looking at include UCO and USO. Those are really easy ones to play that just pretty much relate to oil prices. So if oil jumps up to $30, then USO and UCO do quite well. And there's a lot of other ETFs you can play as well. But just, make sure you're reading the details on them. Some of them are double and triple leverage. Some of them could get repriced. Some of them might have splits. So just be careful on how you get priced in. So USO is one of my favorites. That's a pretty straightforward one. And that's how I'm going to play oil. I think that's a good way to look at possibly a 25 to 50% jump here in the next maybe 4 to 8 weeks, Yep.
Yeah, Chris, I agree. And I'll say this. I think the supply and demand concept and equation of this is going to play out brilliantly. And what's going to happen is we're going to see a supply constraint rally the market because there's so many powerful people, powerful companies that just can't make money at these levels or very, very thin margins at these levels. And they're going to put pressure on the output. And so that's ultimately going to rally the price because I see continued cuts happening. However, that doesn't bolster demand. And so we're going to see prices rally because of supply cuts, which would be great if that's followed with demand. Then you go into this amazing rally into oil that takes us back up to 60, 70, 80, 90. I don't see that happening. I see the oil demand destruction for forever. And I think we've been in it for a while now. But so I see a rally up to that 30, 40, 45, 50. And then that's going to be a brilliant area to short at. And we're going to realize, wow, demand's not coming back like we thought it was. And we're going to go back down, probably put in lower lows than what we see now, have another pop back up. We'll go back up to 40. We'll fall back down to 16, go back up to 35, fall back down to 12. And ultimately, you can play this range, I think, for the next few years and make a lot of money if you do it right.
Yeah, and it's funny you say that because what have we just seen in the last 12 months? Before this finally broke below $40, we saw a range from $40 to $60 for almost a year and a half. So I think that oil establishes those new ranges, and we're just at a new low. We just have that kind of $20 low. If that holds, then really 20 to 40 becomes that new level from low to high, and we just see the supply and demand cycle continue to play out. So I think that's a great thing to look at.
Yep.
And that's pretty much between that the gap we had over that weekend when OPEC decided to have a price war with Russia. Oh, sorry, I mean the Saudis had a price war with Russia. We had that gap over the weekend, and that's between $42 and about $35 a barrel. So that could be that range that we could be sitting in. Now, on that subject, we got New Zealand CAD. This is the one that I'm looking at right here. So let's go ahead and take a look at the chart. This is the New Zealand CAD chart that I'm paying attention to, and I'm a buyer on a New Zealand CAD. And the reason why I'm a buyer on New Zealand CAD, if you look at the range that we're in right here, we're at a support level down here. In fact, let's go to the weekly. A weekly may be able to give us a much better perspective of what's going on right here. And this is it right here. I'm not only at a weekly consolidation level that I'm seeing right here that's pretty solid, but I'm also looking at, let me go ahead and pull up this tool here. Sorry, I thought I had it open here. And so what I'm looking at over here is I'm looking for price to go ahead and support itself. Let me drag that over to the left here. I'm looking for support down about here, where it's at right now. And I'm going to anticipate price to work its way back up. And the reason why I'm expecting that is because notice that we're in a third wave move right here. And with price now in a third wave move right there, I don't know why it's doing duplicate there, but because we're in a price wave right there, we're looking for the fourth wave to move up back up to the fifth wave right up here at the top. And if we can get that taking place, then we are going to see a nice bullish rally from the support that we're at right now. So I'm bullish on this, but I'm watching the market pretty closely here on the lower time frame, and I'm looking to buy in on this, which I'm already got some buys in, but I'm looking to add on to this position to continue to buy long. You can see right here that price is just about almost above the red ribbons. And I'm referring, actually not the price, I'm talking about the blue ribbons. The blue ribbons just about shy of getting above the red ribbon right here, which means we don't quite have a signal yet. But once we get that signal, this may come on Sunday evening, it's going to be hot for us to go ahead and start looking to go long. So I'm definitely at a support level. I'm comfortable trading long. And so all I'm waiting for is the right signal to confirm it, which is not going to be too far off where we're trading right now. I do have already priced in at 84.92 and then 84.65. So I do have two entry points already long on this particular setup right here. Now I'm just waiting for price to go ahead and confirm the next bullish signal. That's the reason why I'm long on New Zealand CAD. Now, if New Zealand CAD, if oil price does continue to stay below $20 a barrel and it continues to dip, and it doesn't see any big major changes in the fundamentals, then we should see oil starting to continue to be pressured on the low end and forcing the New Zealand CAD to go bullish. And so if we do start seeing some major changes, look here, a slow upside move on US oil I don't necessarily think that the strength that we're getting out in the Aussie and the New Zealand dollar is going to change the directional bias for the New Zealand CAD. But that's what I'm hanging on right now. Now, I'm obviously going to go ahead and get out of the market. If we do see some big spikes in oil, I will get out of the market and not trade this any more longer. I'll tell
you, I love the trade. I would put a caveat. We had a conversation with all the analysts yesterday about trading options, the way I trade options and stocks, and I'm very frugal and I'm kind of cheap, and so I always look at something and I always think automatically, how do I buy at a better price? And so, or if I can't buy at a better price, how do I get confirmation that this is the time to buy? So What I'd be looking at is today's bar, and I'm going to get a little wonky on you, but today's bar, we have potentially a fully engulfing bullish bar, and if we can close above yesterday's high, even a pip above yesterday's high, I really like that to set up for potentially an explosion move, at least up to 86, 86.50 into next week. However, if we don't close above yesterday's high, I think there's a little bit of a probability that we see a retracement back down towards this 70 or 84, 83 level. And so what I'm looking at, I'm gonna base it on what today's bar does. I love the long if we close above yesterday's high. I'm gonna sit on the sidelines and try to buy cheaper around this 83 level. If we don't close above yesterday's high, I might miss the move. We might not close above yesterday's high. We may never come down to 83 and the thing rallies up and I miss the move. And if I do, then I got to be okay with that. But that would be the kind of the technical way that I would. So to take that a step further, if we close below yesterday's high, I would maybe even into next week look to deploy Accelerator, Right Trader Max, whatever it might be on the downside, just for a quick kind of couple day retracement down into those 83 levels or 83.50 levels, just to take advantage of that retracement down and then look for that next wave higher. But that's a little technical. That's what I would be looking to do. But I do like the overall, I like the long-term buy setup for sure.
Gotcha. All right. So what I'm probably going to go ahead and do is continue. Now, those levels that you speak about right there, if price gets below that, I'm going to be off the side. I'm going to be off the side and wait for price to get back into that range. So long as we're in this the sideways range that you're seeing right here, I'm pretty comfortable staying in on this trade and holding on to that position. But as soon as price moves out of those ranges, I may have to start thinking otherwise.
Indicated at that wave 4, I'm pretty sure we're going to keep those lows.
Yep. All right, cool. All right, good. And so that brings me to Chris's pair. Chris has got a pair that he's following, and that is the Euro US dollar. Chris, I want to just say this. You're crazy, man. You're crazy. All right. But you're looking at, I know the opportunity is not here yet, but talk about the Euro US dollar. What is your thoughts around Euro US dollar?
Well, number one, the Euro dollar has seen probably one of the wildest marches of any currency pair with everything that happened on the dollar and the stock market. So, we've been forced to wait patiently for something to happen on the Euro dollar. We had that amazing squeeze from 108 to 115. I was prepared for this thing to go to 116, 117. The good thing is I didn't get caught on the wrong side of it. We scalped it up from 108 plus. We scalped it at 112 higher. We tried, we protected our profits when it started to drop. I did not expect it to go from 115 down to 106, 106.50. Now, if you look at the higher time frame, if you zoom out a little bit more, Gary, so we can show some of those previous highs or previous lows from 2016 and 17, we have really substantial 3 and 4 year lows back to 1.05. So we've had a 2-year downtrend, a 2-year channel on the euro dollar. We had this massive shakeout where it just looks like, imagine a roller coaster where there's no seatbelts. Everyone got thrown off the ride. You go from 108 to 115, 115 to 106.50, and now nothing's happening and the ride's starting to come to an end. So volatility is shriveling. Now, we've resumed the structure back inside that 2-year channel that we've had since 2018 when the dollar broke out. So I think that right now there's really no trade on the euro dollar as far as that I like because the volatility is so low. It's gone from 150 to 200 pips a day back in March to now you're back to 30, 40 pips a day. So the level that I'm watching are, it's the previous low from March, right around 106.50. Let me make sure that's right. Right around 106.30, 106.40, and the lows back in 2015, 16, 17 at 105. So I am look, it's a low risk, high reward opportunity. If we have price come back into 105, I'm going to buy it. I'll look for bullish confirmation. I might just buy it at 105 and have a stop loss probably 50 to 100 pips lower and look to see if we can get it's not like I buy the euro thinking that the euro is going to get substantially stronger. I think that there's going to be a move either against the dollar because the dollar index does tightly correlate with the euro dollar. There's a lot of weight on dollar baskets with the euro. And I also think it's a squeeze play. So, we've been eyeing levels on the 10-year treasury notes, the 20-year treasury notes, the dollar index, whether it's US dollar or DXY. And, we're looking at some massive resistance levels that go back 20 and 30 years. So 105 to me is a low risk opportunity to buy the euro at 105, have a stop area around 104.50 to 104.00, and see if we can even stay in the range. The same thing we did for 3 years, 2015, 16, 17. We had a range from 105 to 115. So what if we're literally doing the same thing again? I talked about this week in my trading room. That high in March at 115 and then the low, what if we get back down to 105? I think we can revisit and have that newly found range that was just a few years back. So 105 to 115, 105 to 115. And then ultimately it's going to have to make another decision. But, the euro dollar is the most, traded currency pair. It has some of the highest volume. It's super liquid. So everybody can, participate in that. But the hard part is when you get the big move. We have these big cycled moves that happen in the euro dollar, 2017 French election, 2018 dollar index breakout, this, wild stock market that just disrupted not just the stock market, but everything with currencies as well. So at the current prices, I hate it. I mean, that's why Gary says you're crazy because, there's no reason I want to trade it right now. But if we drift down to 106, I'll be very interested. If we get down and give me an opportunity to buy at 105, I'm going to buy it at 105. So, and from there, I just look at the technical picture of it's low risk and high reward. I mean, if you risk 100 pips to go after 1,000, that's pretty good. You don't get a lot of setups like that very often.
Okay. Yeah. So the bottom line is you're looking to wait for the market to get to that support level, 105, 106, buy it at those levels right there. What happens if it goes ahead and moves to the upside? Is there any time that you can start looking to buy in on the upside, or are you going to be a seller when the market gets up to certain levels?
That's a great question. The first thing we have to do is we have to make a new high. We have the high from 115, the lower high from 111.50, the lower high from this week at 110. We have to break above 110. We're forming this big wedge pattern because we're noticing lower highs and higher lows. So the structure has to change. We have to see a higher high. If we break above 110, then I'll probably look at deploying a scalping system. Right Trader Max would be great to get involved with some type of medium-term swing and see if we go from 110 and then revisit 111, 111.50. If we break above that, let's see if we get back to some of those levels at 113, 14.50. I mean, there's definitely ways to participate. I just think that as we've had that big shakeout, if we're forming a wedge, ultimately that wedge forces a decision. And, and again, I'm neutral. But I just think that, I want to make sure that we're trading with a stop area. I think that the structure on this pattern is pretty clean, that if we are wrong, we know we're wrong. If we're right, then we try to jump on board and see how long we can run with it. So the bulls have to break 110 for me to get remotely interested in buying it at these levels. Otherwise, I would even give credit to the bears. I'd say if the bears break below 107.70, that we can probably revisit those lows from March. I mean, 107.70 down to 106.50. It doesn't seem like a lot of space. You're talking just over 100 pips, but on a 5 or 15-minute chart, traders could be right there with us, and we could scalp that down and make, we could probably grab 50 to 100 of those pips. And if it goes through those lows at 106.50, then we go to 106, 105.50, and bring in some of those big lows back in 2016 and 17. So it's, look, watch the prices, right? Watch the highs and lows, and there's an opportunity either way. So, I mean, if somebody's looking for a trade, set a chart alarm at 110, set a chart alarm at 107.70, and whatever breaks, make sure you close above or below and then trade that breakout. I think that's a pretty straightforward way to get another move on the euro dollar.
Or go ahead and use Right Trader Max and go ahead and put your buy price and your sell price and say, hey, if market breaks above that, I'm buying. If market breaks below that, I'm selling. And in between, I stand aside, right?
There you go. And that that daily, I think that daily candle would be a great great price confirmation, and then try to get like a 15 or 30-minute chart deployed, so you can get some of that precision on those runs. And and again, eliminate risk, and try to grab 50 to 100 pips if you can. Close it higher, let it trail. Just protect your profits, because that is a highly liquid, highly balanced pair. And until we have another massive breakout, I mean, again, you can see that the euro dollar doesn't like to do too much without coming back home. So it's been an interesting run the last 4 weeks.
Absolutely. All right, so we want to try and keep it at, we've got about 6 minutes left. 6 minutes left to discuss some additional pairs. And I want to go ahead and turn it over to Tyson. Euro Swiss franc. That's your pair of the day. Let's go take a look at that pair. I'm going to
switch it up for a minute here, and the reason I'm going to switch it up is because let me just back into this. So I'm bullish on the Euro Swiss. However, I have just started to take some profits and pair off some of my Aussie positions. Also, as I've mentioned last week, but I started to become a little more aggressive on the sell side because I'm looking for about a 50% retracement of a lot of these leg higher that we've had in a lot of these Aussie pairs. So I've started to establish a short Aussie Swiss position. So what does that mean? It means, well, I'm buying the Euro Aussie and I'm selling the Aussie Swiss. So therefore, Gary, we're going to look at the Euro Aussie. That's going to be the trade. And
All right.
I'm going to set up. And this is going to be one of those really, really nice looking trades that offers amazing risk versus reward, does almost exactly what Chris was just talking about, where if we break above a certain level, a very specific level, we break above a certain level, just deploy a strategy. Just deploy your favorite strategy, right trader max, accelerator, turning point, whatever it might be, in that direction to these levels. And so it's fairly simple for me. What I'm looking at is we have filled the gap from that was created back in March, mid-March, and so that's good. What I'm looking for is I'm looking at this week's low at 170 to hold. So what I'm going to do, and I'm looking for a move back up to 78.50. I don't want to just jump in right now. My line in the sands to show that the bulls are finally starting to take control is today's bar. If we look at a daily bar, today's bar is a pretty darn decent signal that the bulls are making an attempt to say, no, we've gone a little too far, a little too fast. Let's try to fight this thing back. And so we're getting a little bit of a longer wick to the south. So therefore, I like today's bar. But what I really like is I like buying or executing buy strategies on a break above today's bar into next week. So if we break above today's bar at 170, 165 on Monday or anytime next week, I want to start to deploy long positions. And as long as price stays above 170, so I got about 165 pip range, I'm going to continue to buy up to 78.50. So I'm looking to make, this is a trade where I'm looking for approximately almost 700 pips worth of reward and about 165 pips worth of risk. Risk versus reward is amazing, but I want to make sure the confirmation that I'm going to use is a break above today's high into next week.
Okay, so let's go ahead and take a look right here. So staying above the low of the week, which is at 1.7003. Making sure you stay below that, but you want to break above today's high.
You want to stay above that. So if I just set up a kind of a core, just normal trade, the trade would look like this. I would buy on a break above 71.65 with a target of 78.50 and a stop at 170.
Okay, I got it. Perfect. So you trading the retracement move of this big bearish move. You're trading retracement move back to resistance.
Yep, that's exactly what I'm doing. I'm almost looking for that you see that bar after the gap. I'm looking for a similar move to happen. So the bar after the gap, the blue bar right after the gap.
Right.
Over a little bit further in mid-March. I'm looking for almost a similar move like that, maybe even into next week.
Gotcha.
No, not that one. So basically March, what is it? March 8th, if you're gonna, March 8th. So that's pretty much where we're at right now. I'm looking for pretty much that almost exact type of move up to my target. Maybe not I don't think it's gonna happen in one day, but I think it's gonna be a fairly quick move, couple day move, 1, 2, 3, 4 day move up to my targets.
Oh, so you're talking about this big bullish move right here?
I'm talking about that bar there. Yep.
And you're looking for this bullish move going back up to resistance.
Very similar. Yep, similar move.
All right, let's take a look over here, and that was the daily chart right there. So let's go ahead and take a look at. I want to break it down from a technical perspective right here, and I'm noticing that I have a downward AB boundary. Price is not reached by 1.618 down here yet, and that's what I'm targeting. I'm targeting 69.34 before we see a rally.
I like that too. The reason why I'm willing to take a shot, because Gary, I think both of us can be right. I think we're going to hit that 618, but I think we're going to retrace first. So we're going to have a kind of this reprieve rally, retrace up, and obviously a high volatility pair. We're talking 700 pips. That seems like a lot, but in a currency like Euro Aussie, I mean it's not a huge move. So I'm looking for. And then once we get up to that 78.50 level, absolutely that's the sell down to that 618 in my opinion.
Gotcha. So you're looking at a 700 pip move to the upside and then a downside move.
Yep.
All right. Perfect. All right. Well. Okay, good. The final pair before we go ahead and close off today, guys, is I want to look at the, let's go ahead and take a look at the New Zealand Swiss franc. And so let's go to New Zealand Swiss right here. So again, probably looking at strong New Zealand dollar, and New Zealand Swiss looks like this on the daily. Let's go pull up the daily right here. So if you look at the daily, I'll go ahead and compress as much as I can to get as much information. In fact, I'm going to go to the weekly so you can get a much larger perspective of what's going on right here. So we're range bound, hit support there, holding that support. So I'm looking for price to move back all the way up to the top of the range. I see this as a long-term, let's see here, 2,500, 2,300 pip opportunity to the upside. It's holding that support right here. I'm moving down to the lower time frame to look for trading opportunities here. But also I'm looking at, if you want to do any sort of like, if you want to pick bottoms, you can go ahead and use a bit of divergence. And if I look over here, let's see if I got a large divergence setting up right here. Nope, I don't have anything here. Oh, we do. We may have price moving higher right here. I don't think it's quite getting it. No. So what I'm going to do is this. I'm actually deploying a right trader max, and I've gone ahead and deployed it long already. And I'm looking for price to confirm its trend. So which means I'm looking for the blue ribbon to trade above the red ribbon, and to have price in the buy zone. And then I'm going to go ahead and start buying long. Keep my stops below the 1 hour or even the 4 hour lows. Just make sure I keep the stops outside the way. And then I'm going to be chasing after. In fact, there's no specific target that I'm looking for on this particular pair. All I want to do on this particular pair is I want to deploy it long, all right, and continue to trade and take my 1 to 3 risk reward ratios on it. But I'm chasing after the top of that the daily or weekly range that we saw on the chart. And so I'm going to continue to buy and sell, buy and sell. But what I am going to be paying attention to, guys, is I'm going to be paying attention to the inside structure based on idiot wave. So I want to make sure that that I'm not trading on a fifth wave and I'm trying to buy in at a fifth wave, because I'm expecting a deeper correction once price hits a fifth wave.
Hey,
so
Gareth,
as price goes,
your charts,
what?
your screen's black.
Oh, my screen's black? Okay, let's go back to the charts. I do appreciate you telling me that. So what I'm doing is I'm looking for price to go ahead and move back to that level, right, on the daily. And let me go ahead and flip over the daily range right here, so we can see exactly what that looks like. So this is it right here. Call it daily, weekly range here. So right here at the top, this is the top level. Now, as price goes ahead and trades back and forth, I'm going to be paying attention to the actual wave structure. And the reason why I'm paying attention to the wave structure right here is because I want to make sure that if price is going to trade inside that, or at least at the fifth wave of a wave structure, I want to make absolutely sure that I am not trading that at all. I want to make sure that price is not going to be at a very key level of resistance, and I'm still trying to buy in, because with any sort of trend trading system, if you're trading a trend trading system and you're not paying attention to the overall structure of the market, then what you're doing is, if this system goes ahead and pays out and takes profit at a certain level, which is in the fifth wave move, and now you're looking to rebuy in at that fifth wave, you're probably going to get some losses taken on that trade. Even if you try to trade in a fourth wave move at the top of a fourth wave, because fourth wave is a consolidation, right? You want to make sure you keep buying at the bottoms of those moves. But if you're going to continue to buy in at those resistance levels, then what's going to happen is you're going to give a lot of the profit that you made on those trades, you're going to give it back until the market retraces back, and then go ahead and start looking for that next extension move. So even though we've got a 2,500 pip opportunity on that pair, I'm really going to be paying attention to the inside structure, making sure that by the time it gets to a fifth wave, I'm going to allow the market to go ahead and have a deeper correction, just like pretty much what you're doing on the euro Aussie dollar, Tyson.
Yep.
Is that you're waiting for that correction move and you're trading that correction move if price does what it needs to do. And I'm going to be doing the same thing. It's interesting that you say
that, actually, because I agree 100% with the long-term outlook. However, I see this trade almost exactly like the Euro Aussie, where if we break below this week's low, I see a mimic move of what we did in that March 5th move. I basically see us going down to 55.70. But I think that level, that 55.70 level, is a brilliant long-term buy zone.
Yeah, as long as we stay above that, and I've even in my trading room as well, I've even notified everyone saying, hey, listen, I'm a big buyer on New Zealand Swiss right here. As long as we stay above 56.88 right there, labeled there, and I said stop buying at that point. And then what I'm not going to do is, and this is a lot of traders get caught up in this, what I'm not going to do is I'm not going to sell below that automatically. I'm not just going to start looking to sell. I'm going to wait for the confirmation of the break, see if it's validated, and then I'll go ahead and trade it. But I have to see a clear indication that price is on its way to the downside, because then this channel that we have right here from this level is going to look something like this, where we have price trying to chase after this bottom support right here of the channel, because that's the only support that we're going to find on this particular chart. But that's what you said on that.
I don't necessarily think it's, I think that you're right on where you're telling your students to stop buying at. I think that level might be protected. I'm not convinced though that if we break that level that we're going to go down and retest that downside channel. Because I do see this 55, 70, between this 53, 55, 70, 56 level. I see that as potentially a longer term bottom in this pair, or at least longer term being a couple months.
Right. Well,
that's a
this
big
is
difference.
The thing. It's.
I'm not saying it's going to be an all-time low. That's the new long term, right?
Well, look. If it's a confirmed break, if we have a nice clean break, a retest of resistance, indecision candlelight resistance there, confirming that we're now seeing a strong level hold, then I'm going to be looking to sell. I'm not going to just sell on the break, because I'm going to be worried about that false break that a lot of traders get into and get caught up in that mess. So, yep, that's the deal. All right, guys, the final words. Chris, final words to you.
Final words. We have 2.5 weeks before the end of the month. I'm excited to kind of get into May to see what happens. I'm going to be, so the important thing for me as far as my portfolio, my trading, and my trading decisions is I want to be positioned accordingly. So I did end up doing a lot of maintenance, a lot of washing, where I had some drawdowns and some trades. I worked myself through to get some profits back. I took some profits and washed away some drawdowns. So I have freed up a ton of margin. I've freed up a ton of Tyson likes to call it dry powder, but it's like I want to be ready for whatever comes our way. And I've been asking traders this in my room, and I've been posting this on social media stuff. If traders had the opportunity to do March again, how would you trade differently? Because if we end up seeing May in a similar fashion to March, or maybe not, but it's just I want to be prepared for whatever the market throws at us and not be stuck, in a position, or not be hoping that it still comes back. I mean, look, all these Aussie pairs that just got crushed for the start of the year with Aussie brush fires, and it got crushed with the March sell-off and everything, China coronavirus, you name it. And now the Aussies made this amazing comeback. We've had 500 to 1,000 plus pip recoveries on a lot of these currency pairs. So yeah. If you haven't been able to turn those drawdowns or negative positions into positive trades, or at least mitigate a lot of those losses, you're left just really hoping and praying that it still goes your way. When the reality is, look, a 1,000 pip recovery anytime you have a 2,000 pip move, a 500 pip recovery on a 1,000 pip move. Look, if the market balances at those 50% levels, if you're not able to get that to profit, it's still just thinking about risk. Is it worth holding? Because as we've said, we might see those lows retested. Now, I think that the New Zealand Swiss low, the New Zealand CAD low, the Aussie Swiss, I think those lows from March are significant. Those tops and bottoms from March's runs in the currency market are really significant. So sure. Rather than letting price fluctuate and slowly get back to them and watch drawdowns get worse again, why not, again, if you've worked yourself through trades, be ready for trading. Be neutral and deploy a system to make profit in the short term, and then manage the long term. So, I'm focused on the pair we talked about last week was Aussie New Zealand. That had a great run this week. I've had 21 positions in. I scaled it back to 12. I'm up to 16 right now. So I'm back in. I'm back out. I'm getting all sorts of trades, and I'm going to continue to ride that Aussie New Zealand as long as I possibly can. That's a great trade for me. Euro Swiss, I'm long on Euro Swiss, and I'm just waiting for more confirmation. I'll get really aggressive with more confirmation. But like Aussie Swiss, Aussie dollar, I'm completely out of those trades. Those were some that I was carrying. I managed to get myself into profit off the flash crash lows and off the drawdown even further. So getting back into profit, washing some of those trades away, and then having no trades on the table, I'm positioned for whatever comes our way. So if the yens get stronger, and I know I'm taking up a lot of time here, but look, it's just be neutral. be nimble. That's all I'm saying. So I don't know what March or what May brings. There's a saying, sell them May, go away. If the stock market has another drop, but the stock market thinks that, we're ill prepared to return to normal as far as business and how the consumer changes and how everything changes coming back into, going outside again for the first time in 3 weeks, then it's going to be an interesting market. It's going to be an interesting psychology that we're going to have to be ready to trade.
All right, cool, great stuff. We did, Tyson. We did tell Chris to make it a 2-minute final words, right?
Yeah.
I knew it.
Yeah.
All right, no worries. Good information there, though, Chris. Thank you, appreciate that. And Tyson, final words, final 2-minute words.
Yeah. So with me, it's I'm going to be cheap. What I mean by being cheap is I expect a repeat of March, maybe not in May, maybe not in June, but I think we free things up and then we find ourselves right back where we're at right here, right now, a couple months later, unfortunately. With that being said, be prudent, be frugal, be smart, save up, take advantage of the opportunities you see. But, over the last 3 weeks, I've grown one of my core stock portfolios by 33%. A long-term portfolio, 33%. By taking advantage of opportunities, but that's crazy. That's crazy. That doesn't happen. So I am aggressively raising cash right now and aggressively looking for great opportunities to buy high-quality stocks again at lower prices. I think there's an opportunity, guys, and this is going to sound crazy, but I think there's an opportunity to even get in 10, 15, 20% lower than the recent lows.
Agree.
So we'll see how it all comes out. If I'm wrong, I'm going to miss out on some of the upside. If I'm right, then there'll be amazing buying opportunities. I'm willing to miss out on some of the upside to make sure that I get the prices that I want to buy. So I'm always asking myself, and this is the last thing I'll say, always asking myself, where do I want to buy? And most of the time, it's not right here. And by doing that, I'm going to miss out on some opportunities. But if I do that consistently, I'm also going to get some stocks and some holdings that I'm just thinking, man, what a brilliant buy price. And it's worked out well for me.
Sure. All right. Perfect. Well, you know what? I'm going to say don't be cheap. All right. Unless you're buying cheap. All right. But don't be cheap. This is the deal. My final words are going to be very simple. What we had in March was a lot of volatility, and a lot of traders actually took a lot of deep drawdowns. And so use this as a good learning curve. Don't think that, okay, it's a flash in the pan, it's never going to happen again. It may happen again, and it may happen very soon. So what you have to do is, if you've gone ahead and went to deep drawdowns with the March volatility because you're in the wrong direction, but you continue to add on to position because you were committed to a trend, this is the deal. Make absolutely certain that you take this and learn from it. So which means coming back, moving forward, and not just coming back, but moving forward, what you want to make sure about is that your equity management is calculated correctly. And how do you do that? Remember something. There's always going to be what is your total risk on the table going to be? What is the worst drawdown that you want to have on your trading account? Everyone has to have that, right? And if you don't have that, start having that, right? So figure out this is the maximum drawdown that I want. If it's going to be 5%, 10%, whatever that number is, make sure that you say, all right, at 10%, does that keep enough equity? If I get to my 10% drawdown on my trading account, does it allow me to still have buying power? What does that mean? It means that you still have equity to be able to add on to positions and you start liquidating positions. So you want to go ahead and make sure that you calculate that. Also, make sure that you're not focusing on 28 currency pairs, right? Because if you focus on 28 currency pairs, you have to reduce your risk per trade extremely low. I'm doing it on target trading, daily targets. I've got a 0.04% risk on each trade. It's crazy, all right? But you know what? I can trade 28 currency pairs and not get into any equity issues. So do the math. Make sure that you calculate all that up before getting into your trade, because the last thing you want is March to come around and you are doing March volatility to come around again, and you're not properly prepared for it financially, or at least from a risk percentage. From a risk aspect. So make absolutely certain that's key, because we're going to get volatility. And if we are going to get volatility as a trader, we love that. I mean, we love volatility. We don't want these slow daily trading ranges. We want high daily trading ranges so that we can go ahead and trade these big ranges and make good pips day to day, and allow us to be able to continue to trade through this volatility without risking blowing your trading account. We do not want to ever have that case scenario. So risk management is absolutely key to any successful trader. With that being said, traders, I want to thank my team, Chris and Tyson. Great information that they've passed on to you guys. Grab it, go through the video a couple of times. Make sure that you learn by these guys, because they're certainly giving some great information over to you guys. All right. So with that being said, guys, thank you very much. Appreciate you guys, and we'll see you guys next time. This is the FX Big Dog and the team saying happy weekend, and we'll see you next time.
Take care.